One morning, the silver market opens like any normal trading day, but within minutes something feels wrong. Traders expecting physical delivery suddenly receive a notice saying, "Settlement will be paid in cash instead of metal." At first, it sounds technical and harmless to outsiders. But inside trading desks, phones start ringing, because everyone understands what this really signals. Cash settlement is not used when markets are comfortable. It is used when the system fears it may not have enough physical supply to meet delivery promises. For decades, investors believed futures contracts guaranteed real silver if requested. That belief is what keeps confidence in the entire pricing structure alive. Before we go deeper, if you follow financial warning signs and want calm explanations without hype, subscribe now and stay with Bullion Alert HQ. Early subscribers are usually the ones who understand major shifts before headlines explode. Now imagine thousands of contracts suddenly requesting delivery in the same cycle. Warehouses begin checking inventory numbers, while brokers quietly calculate exposure. Most viewers do not realize how many paper claims can exist on a single ounce of silver. In leveraged commodity systems, the ratio between promised metal and available metal can become extremely stretched. Normally, this does not matter, because most traders close positions for cash anyway. The system depends on the assumption that only a small fraction will ever demand real bars. But a crisis changes behavior instantly. When financial stress rises, investors stop trusting promises and start demanding assets they can actually hold. Industrial buyers behave even more aggressively in that situation. Factories cannot run on paper contracts, so they scramble to secure real shipments immediately. This creates a dangerous feedback loop inside the exchange. The more people fear shortages, the more delivery requests rise. And the more delivery requests rise, the higher the probability the exchange must protect itself. That protection often comes in the form of emergency cash settlement rules. To the public, the announcement might sound like a routine administrative adjustment. To market professionals, it sounds like the fire alarm inside the financial building. Because the moment real delivery stops, price discovery becomes questionable. If no one can freely exchange contracts for metal, the futures price may no longer represent true physical value. At that point, two markets begin forming simultaneously. One is the official paper price, and the other is the real-world physical price negotiated privately. History shows that when those two prices separate, volatility tends to accelerate. Investors rush to reposition before spreads widen even further. Large hedge funds would immediately evaluate counterparty exposure. Banks would begin stress-testing liquidity scenarios overnight. Media coverage might initially stay calm. But behind the scenes, treasury departments, refiners, and bullion dealers would already be preparing emergency supply strategies. Retail investors often assume exchanges cannot allow this kind of event. In reality, rulebooks already include provisions for extraordinary settlement conditions. Those rules exist precisely because commodity markets understand physical shortages can happen. And when they happen, maintaining system stability becomes the top priority. But stability for the system does not always mean stability for prices. In many historical cases, emergency actions actually triggered larger market moves afterward. Because once participants realize delivery risk exists, trust never fully returns to the old level. The psychological shift alone can change long-term trading behavior. At Bullion Alert HQ, we focus on these psychological turning points more than daily price swings, because structural confidence is what truly holds markets together. If the day ever came when silver settlement switched to cash broadly, the immediate question would not be about today's price. The real question would be how many institutions suddenly need physical metal outside the exchange. And that demand migration could reshape the entire global silver supply chain. Which brings us to what might happen in the hours and days immediately after such an announcement. Within hours of a large cash settlement notice, bullion dealers would likely see a surge of calls. Investors who never cared about physical silver before would suddenly want allocated inventory. Premiums on coins and bars could begin rising the same day. Logistics firms would start prioritizing insured transport, while refineries check production capacity. Industrial manufacturers would face an even tougher challenge. They cannot pause solar panel lines or electronics assembly simply because markets are stressed. So procurement teams would start locking supply contracts at almost any available price. That urgency alone could push real-world silver costs higher regardless of futures quotes. Meanwhile, financial television might still describe the situation as temporary, but institutional risk managers would already be adjusting exposure models overnight. Short sellers would become especially nervous. If the market believes physical silver is scarce, covering short positions quickly becomes extremely expensive. That forced covering can create rapid upward price pressure. And rapid price pressure often attracts momentum traders, which accelerates the move even further. At the same time, some investors would rush into gold as a broader safety hedge, but historically, silver often moves faster in percentage terms once panic demand begins. This combination of industrial need and investor fear is what makes silver unique. It is both a strategic material and a financial asset at the same time. Governments might issue calming statements emphasizing market functionality. Central banks could coordinate liquidity support to prevent broader credit stress. Yet confidence in commodity settlement mechanisms would already be shaken, and once shaken, markets rarely return to their previous comfort level quickly. Portfolio managers across pension funds would begin reviewing commodity allocation rules. Some would shift mandates toward direct physical backing rather than derivative exposure. This gradual institutional shift could last months or even years. Structural transitions in finance rarely reverse overnight. For everyday viewers, the important lesson is not predicting the exact day of such an event. The important lesson is understanding how interconnected delivery trust and pricing stability really are. Because markets do not collapse only from bad numbers. They collapse when participants stop believing the system will perform exactly as promised. If this explanation helped you understand what a silver cash settlement scenario truly means, drop your opinion in the comments and tell us whether you think it could ever realistically happen. Your insight helps guide what investigations we cover next on Bullion Alert HQ. And if you know someone watching inflation, metals, or global finance, share this video with them so they understand how settlement rules can shape real prices. Awareness spreads fastest when informed viewers pass the signal forward. Stay calm, stay informed, and keep watching the deeper structural signals instead of daily noise. Because in modern markets, the biggest changes always begin quietly before the world notices.